The greatest issue that you will face as a trader and an investor is not where to buy. Where to buy is really simple. Where to sell is the issue. I'm going to walk you through the logic that I apply each and every day to my trades. You can see these little green arrows, that's where I buy. The little red arrows, that's where I sell. And this is live trading history. This specific one is on Doge. Let's have a look at Solana. You can see that Solana has a different structure. I was accumulating here and disposing of it up there. So this is something else to bear in mind. All the structures underpinning each chart will be different. I'm going to take you through the key psychology that you need to apply to do what I do. If I do it, you can do it. But it does require a very specific way of thinking. Just another thing to note, each one of these little red arrows represents a reasonable rate of return that you could get inside a bank for 12 months. And I'm generally getting that bank rate within a day or so. If this kind of information is helpful to you, don't forget to smash that like button and please subscribe. Let's run the numbers. To get psychologically prepared for profit, it's vital to understand the directional movement and the structural levels of support and resistance inside the Tier 1, Tier 2 and Tier 3 charts. I've showed you some trades on Doge and Solana, but I would not do either unless I understood the structural levels of support and resistance on the Tier 1, Tier 2 and Tier 3 charts. This is very different from what the majority of people do. They'll just hone in and look at Doge and look at Solana, and they will miss all of these other cross interdependencies and interrelationships. It's vitally important to look, especially at the Tier 1s. Without this knowledge, you will consistently buy when you should sell and the other way around. You'll sell when you should buy. The next step, when you understand how the Tier 1, Tier 2 and Tier 3 charts are moving, and what we've seen recently, the US 2-year, the US 10-year have declined substantially. This has brought down the DXY. It's spiked junk bonds. We've seen the Japanese yen fall, and we've seen the euro and the Aussie dollar rally. All of this is vitally important to understand. It impacts our trades inside the crypto market. When you understand those cross interdependencies, now we go to total crypto market cap. You will find that when you're just starting, price movements look absolutely chaotic. Price is all over the place. But when you understand the structure, it's completely different. When total crypto market cap is coming into structural support, we expect it to bounce up, and that's just what happened recently. We've been having a lot of trouble getting above this structural resistance level at 1.4 trillion. We've just not been able to hold above it at the current time. Understanding the interplay between total crypto market cap, Bitcoin, Solana and Doge is your next steps. Bitcoin is totally in a fresh air gap at the current time. Its price is being influenced by total crypto market cap, but it's being influenced by other things as well. I was mentioning before that it's really important to keep your eye on the Forex pairs, especially the DXY. You can see the DXY has been coming down, but what if I invert that? I'll show you something magic. You can see that the inverted DXY gives us a very good feeling on where Bitcoin could be going. This means if the DXY is going up, we expect Bitcoin and crypto to be coming down. The concept of directional correlation is very important. Here I put the Nasdaq futures up. You can see the Nasdaq futures have an influence on risk on and risk off activity. Many people inside the crypto market think it's all about a Bitcoin ETF, and whilst that's important, a Bitcoin ETF cannot override the association between the main markets and crypto. A mistake people make is thinking that it must be a perfect overlay of a chart, one chart to another. This is not the case. You want to get a general direction. As a former statistics lecturer in first and second year stats, I can tell you that there are many ways to calculate correlation. Directional correlation is the most powerful. Literally, you can see that these two charts are associated with each other. They're moving basically in the same direction. For example, as the Nasdaq was coming up, we saw that crypto was also coming up, but crypto creates a more risk-averse situation. If crypto is coming down, we can cross-correlate that the main markets are in all likelihood going to retrace. In other words, in simple terms, crypto feels it first. Then we start to layer down into the structural levels of DOGE and Solana. Popping on the indicator gives us an understanding as to where the strong resistance and strong support levels are inside the market. These are our guide rails. If price can't get above a resistance level, it's coming back. If it can't rally, it's coming back to the next one, and so forth and so on. It's a very simple structure to understand and apply. If it's not going above, it's going below, and if it's not going below, it's going above. It couldn't be more simple than that. With an understanding of how the main markets are moving, the forex pairs are moving, we then drill down into the crypto market to what we want to put money on. But we never do it blindly. We do it with a knowledge of structure, and this structure through the CTKS method accounts for more than 3,600 days worth of price data. It is not recent indicative price analysis. You will see that 99% of people do RIP analysis. It's called RIP because it RIPs your money. For example, if we just go back a little bit in time, and let's just pop the indicator off. If we're seeing this, when price was coming down like this, everybody would say, oh, it's all over, we've lost support. Where was the support? It wasn't even there. It's there. The next support level was down here. And because we buy on red with a knowledge of structural support levels, and especially how strong they are, and we sell on green, that means that we know where the structure is above, and we can just lock in our annualized bank interest, and we can do that in a couple of days. A lot of people have savings in the bank, and they never realize that the banks make their money by not only loaning out, but trading those funds. With a knowledge of trading, you can trade your own funds. It's an incredibly powerful way of compounding your returns, which brings us to the next area, which are percentages. There's a few things to understand with percentages. The first thing is the absolute investment increases or decreases the gross absolute change. This is a very important thing. Your return is measured in dollar terms, in absolute terms, by what you put in. The more you put in, the more you get out. But that's not really the issue. The issue is something completely different. A lot of people get stuck on the concept, I must make a huge return. After all, I've seen these people on YouTube. They get $200,000 in 24 hours. Typically, investment returns like that are created by putting an incredible amount of leverage into the market, only getting a very small absolute return on investment, which creates a mind-numbing gross absolute change. It's so mind-numbing that people fall for it. They say, oh, 200,000, I wouldn't make that in a year. That's awesome. I need to just learn what this person is talking about. But what happens if it didn't go 2% up? What happens if it went 2% down? What I would like you to do from now on, if you see any thumbnails or any talk about huge gross absolute changes, the gross return, please think about how much money they're absolutely putting in and what leverage they're using. All the trades that I do are at spot. Spot trade means that I own the money. I'm not borrowing from anyone. I don't pay fees. You definitely pay fees when you get into leverage and derivatives. And also, with derivative trading, you do not own the underlying asset. The key thing to understand, if you put $100 in and you had a 2% absolute return on investment, you just made $2. You're getting people going out there just pushing an enormous amount of leverage into the market and saying, you can do this too, no worries. And what is the gross absolute change if you put in less? Well, it's much lower, but this is not the issue. What the actual issue is is this gross annualized return on investment. If you could do 2% on $100 every single day, you would find that your gross annualized return on investment, this is without fees, your buy fee and your sell fee. Sell fee. Not that sell fee. Would be really, really high. And you can see, depending on your fees, it can get lowered down. So you must be aware of the net annualized return on investment as well. I'm putting a series of calculators together, and I created this calculator, and I'll let you know when they're live. I'd like you to think about something else. If you could put an X amount of money in, get a 10% return, that return, if you could do it within a day, is very, very powerful. The greater your percentage return, the greater your gross annualized return on investment is. That's something to keep in mind. One thing also is that you can cycle out. If you put 500 in, you got 10% out. You've just made $50, but you've got your money back as well. This is wildly, wildly powerful, and it's a technique that I use inside the markets all the time. I keep on recycling my money. When you see I'm buying at structural levels, I'm understanding what I'm doing. I know where the market as a whole is going. I'm not guessing, I'm not gambling, I'm working inside structure and directional correlation with an understanding of gross annualized return on investment. When I sell, I'm selling at a specified level, which literally locks in bank interest for 12 months. Each one of these red arrows is literally money out of the bank. And you can see from time to time, Solana especially gets really spiky. It will just take all your buy levels and take them all out of the market at one time. The next thing that you need to understand when you're coming into the market and you're buying on red, a lot of people will get phased out around this particular point of time because they've done all of this buying and price is keeping on going down and down and down and down. Of course, the news just reflects current market sentiment. Can you imagine if the markets were completely bullish and somebody came out and said the markets are tanking? You would say, these people don't even know what they're talking about. The markets are going up. Therefore, what you have with the news is just a reflection on where the price is going, right at the current time, not where the price will be in 24 or 48 hours. This is very important to understand. When you see all these little red arrows, that's literally bank interest for 12 months. And you can see the recycling of trades. When a little red arrow is hit, the money goes back into a structural level and patiently waits there for a buy on red. When it's a fill, it's a targeted rate of percent return and it just patiently waits inside the market. A lot of people say, but Ken, what if I'm buying all the way down and then I just get freaked out, fear overcomes me and I sell? Well, we're happy to leave buy on red levels in the market. Be happy to leave sell on green levels in the market as well. That's what I do. If you know the overall structure of the market, this is no problem to do. But if you're consistently guessing and you don't know where the markets are headed, you will get freaked out. Let's pop across to Doge. We can see that Doge, I was doing this buy on red as the price came down because we get onto the right side of the percentage. That's why we buy on red. We sell on green because we're de-risking our portfolio. As things go up, we're actually de-risking our entire portfolio. It's very powerful. And then you just recycle the money that you just got from your sells and you pop it into buys, and then you recycle and you just do that, rinse and repeat. It's a license to print money. What typically happens, people lose their license to print money whenever fear enters the door. If fear is causing you to buy and you to sell, you can already know that you're making losses. This is really, really normal and happens at the start of everybody's journey. It's just a rite of passage. What typically happens when people first enter the markets, they see the prices going up and they get so happy. Wow, this thing is going to the moon. No, it's going to structural resistance. And when structural resistance is hit, it will retrace. Price is always moving in a wave. These people are retail. You do not want to be retail. If you're retail, you will consistently buy at the top and sell at the bottom. And you can see this cartoon is powerful. It explains that when everybody leaves the dance floor, this is the dance floor, when everybody leaves it, that's where you should be. You should be buying as these dips occur. But people don't do that because they don't understand CTKS structure. However, smart money does. They run the numbers, and you need to run the numbers as well. Another thing I do is to go to ctksnews.com, and under the Market Analysis tab, there's a list of macroeconomic data releases. We can see consumer confidence came in stronger than anticipated. We have a lot of things that can hit the market. They're all high impact events. And Fed Chair Powell's going to speak in a little over 24 hours. So just please bear in mind, prices could get really volatile during this period. Having a context on where things could be going is really important to you placing your trades. The secret sauce of this methodology is to understand the structural component levels of the Tier 1, Tier 2, and Tier 3 charts way before you even put money in on a specific trade. If you don't understand what could happen, you're just guessing. If you're guessing, you're gambling. If you're gambling, the house will win. If you would like the indicators that I've been using on DOGE and Solana, and they're all across these other different charts as well, just pop across to ctksmethod.org. You can see there's a bit of work to do if you want to become consistently profitable, but consistent profitability is always earned. It is not given. Consistent profitability means that you understand where the structural support and resistance levels are, and you will find each and every chart has different levels. It's your understanding of these levels and how they interact across charts that will make you consistently profitable. Keeping your mind positive through the CTKS Creed and positive excellence is very important. Be dedicated and committed. You've got this. You can succeed, and you will succeed. If you put the hard work in, you'll get the results. Remember, fear is a useless decider of when to sell and when to buy. Always just bear in mind that you either win or learn. If you blame, you'll lose the lesson, and you'll get the loss again and again and again until you learn. That's why it's vitally important to just focus on your learning. How do you do better the next time? If you've liked the content, please smash that like button, and if you're new, a very warm welcome. And please just reach out and say hi in the comments. If you have other topics that you would like me to cover off, please let me know. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next exciting video. Bye for now.